This concept video introduces the worksheet, which is what an accountant uses to summarize all the adjusting entries to determine if the adjusted trial balance will balance, and then to sort the accounts into those that belong to the income statement and those that belong in the balance sheet. This is what a typical worksheet would look like. First we have the trial balance. Then we have two columns for adjustments, debits and credits. Then we have the adjusted trial balance. Then we sort the accounts into those that belong in the income statement and those that belong in the balance sheet. Now to begin with, the trial balance. We're going to use this trial balance here of a small company. And we have a listing of the accounts, cash, supplies, prepaid. They have debit balances, so they're in the debit column. Notes payable, accounts payable, unearned service revenue. They have credit balances, so they're in the credit column. Notice, debits 28,700, credits 28,700. So now we can begin. We can then look at the journal entries that have to be made in order to adjust these records to recognize certain expenses and certain payables. And as you can see, we made some adjusting entries. We debited supplies expense, $1,500, and credit supplies. That is, we recognize the expense and reduce the asset. We had insurance expense and reduce the asset, prepaid insurance. If we had prepaid rent and we used up that, it would be rent expense, debit, and credit prepaid insurance. We also looked at how we record depreciation and the accumulated depreciation. Our old friend unearned service revenue, and we recognize revenue. Then the accrued revenue, we have accounts receivable of $200, service revenue of $200, accrued expenses, interest expense, and salary expense. So those are adjusting entries. Now, before we post them to the general ledger, we test them and see if everything's going to be in balance, and that's the purpose of the worksheet. And here are the journal entries. They're in your general journal under the heading Adjusting Entries. To begin with, we have an adjustment to supplies. Debit supplies expense, credit supplies. We have an adjustment to the prepaid insurance account. We recognize insurance expense and we reduce the asset. Again, we've used up some equipment, so we recognize depreciation expense and accumulated depreciation. Unearned service revenue, we will talk about what that account is later. It indicates that we have earned some of the service revenue, so we make the adjusting entry, and so on. Now these are recorded in your general journal, but before we post to the ledger and summarize the ledger, we use the worksheet. We post it to the worksheet. So here we enter each one of those transactions. For example, the first transaction was a debit to supply expense, and that would be down here, A, $1,500, that should be A, and a credit to supplies, $1,500. The second one was a debit to insurance expense, $50, and a credit to prepaid insurance. And so we simply put them in the debit and credit columns. Here we have a debit to unearned service revenue because revenue went down, and a credit to service revenue. Also the accrued revenue, debit to accounts receivable, and credit revenue earned. Same with salaries payable. We had salaries expense. We did the $1,200 there, and salaries payable. So we totaled then all the debits, $3,440, and all the credits, $3,440. Now, our trial balance balanced, our adjustments balanced. Now we put the two together. Now it doesn't mean that we add 344 to the 2,800. No, we simply put them together. Cash was a debit balance in the trial balance, no adjustments, so it's a debit in the adjusted trial balance. Supplies was $2,500 in the trial balance. There's a $1,500 credit against that, therefore they would have a debit balance of $1,000. Prepaid insurance was $600 debit balance. We have a credit against that, therefore it would have a debit balance of $5,550, or $550, sorry. Nothing on equipment, nothing on notes payable, accounts payable. Unearned service revenue, now watch that, it had a credit balance of $1,200. We have a debit against that. We reduced that liability. The liability now is $800. And so on. And the adjusting entries have created some new expenses down here. For example, depreciation expense and interest expense, and also interest payable and salaries payable. So we add these two together. We add up the debits again, $30,190. We add up the credits and we make sure they balance. Now, we sort the accounts into the income statement and balance sheet. We start with the income statement. Well, first of all, service revenue was a credit here, would go over as a credit in the income statement. All these expenses are debits in the adjusted trial balance. They will be debit on the income statement. So supplies expense would be a debit in the adjusted trial balance. It would be a debit on the income statement. And that's what we do. We sort the accounts that belong to the income statement into the income statement columns. And the result is we have a credit, which is the revenue, $10,600. And we have salary expense, rent expense, supplies expense, insurance expense, depreciation expense, and interest expense. So now we total the columns, and we have $10,600 in credits, but only $7,740 in debits. So we don't balance, but of course we wouldn't balance, because the credit represents revenue and the debits represent expenses, and we would hope that the revenue would exceed the expenses. So we would expect the credits to exceed the debits. Now, we then sort the rest into the balance sheet. The cash goes into the debit of the balance sheet. Supplies, $1,000. We just go back here to the adjusted trial balance and we carry this total over here into the debit columns. Now, these won't balance because what we had is retained earnings up here of common stock retained earnings of $0. There was nothing in it. But now we know that the net income, which is the difference between revenue and expenses, should be added to the retained earnings. So next we sort the balance sheet accounts. And once we sort them, cash in the debit side, prepaid insurance, what have you, the liabilities, notes payable, accounts payable. We have salaries payable down here too. That's a liability that was created, as well as interest payable. And we have accumulated depreciation, which belongs on the balance sheet, and accounts receivable, which was created by one of the adjusting entries, and so on. When we total the debit side of the balance sheet accounts, we have $22,450, and the credit side is $19,590. So you see the difference between this and this. If it's exactly equal to this and this, we know that once we determine our income our profit and add it to the retained earnings, then the balance sheet would balance. And that's what the next slide will show. And here we have it. The difference in the income statement between the revenue accounts of $10,600 and the expense accounts, $7,740, is $2,860. And the difference over here, the debits exceed the credits by exactly the same amount, $2,860. So you see, when we add this $2,860 to the retained earnings, then this side, the credit side of the balance sheet, will go up to $22,450, which will equal the assets. And therefore, in this case, we know that the debits equal the credits, that everything is in balance, and we have not made any kind of major errors or any type of errors. We can now proceed to do a formal income statement, revenue minus expenses, a statement of retained earnings, as we did in week 1, and a classified balance sheet with these account numbers here. And in that way, the accountant is able to ensure that the preparation of financial statements is correct and complete. Now, Once that happens, the next step would be to close the accounts, and that would be the next video.